Imagine you wake up one morning and every bank in your city is gone. Not robbed, not burned down, just gone. No insurance, no hotline to call, no government promise that your money is safe. Just gone. That was not a nightmare. That was Tuesday in America in 1912. And the story of how ordinary people survived it and who got rich off their desperation is one of the most important stories nobody ever told you. Before the Federal Reserve existed, before deposit insurance was even a dream, before the words "too big to fail" had ever been spoken in a Senate chamber, Americans handled their money in a system so wild, so dangerous, and so tilted against the working man that it makes the 2008 financial crisis look like a minor accounting error. This is the story of that system. This is the story of who built it, who it served, and who it buried. And if you think it has nothing to do with your life today, stay with me, because by the end of this, you are going to see your own wallet in a completely different light. Let us start with a picture. Close your eyes and imagine a main street in a mid-sized American town in 1912. There is a dry goods store, a blacksmith, a saloon, a church, and right there in the middle of the block, standing taller than the rest, built with thick limestone walls and heavy oak doors, is the bank. It has the biggest building in town. It has columns out front that make it look like a Greek temple. That was not an accident. The men who designed those buildings wanted you to feel something specific when you walked in. They wanted you to feel small. They wanted you to feel that you were entering a house of gods, not a place of business. They wanted trust, and they wanted submission, and in 1912, they got both. But here is what nobody told the farmer who walked through those oak doors to deposit his harvest earnings. That bank was probably one bad season away from collapse. The man behind the marble counter in the pressed suit might have been lending out your money to his cousin's land speculation scheme in Oklahoma. There was no federal overseer checking his books. There was no national standard he had to meet. In thousands of towns across America, the local bank was essentially one man's personal piggy bank, dressed up in limestone and respectability. This was the world before the Fed, and it was both more human and more brutal than anything we live with today. To understand how Americans really banked in 1912, you have to first understand something that modern people have completely forgotten. Money itself was a mystery to most people. Not a philosophical mystery, a practical one. On any given day in America in 1912, the money in your pocket might include a national banknote issued by a bank in Ohio, a silver certificate printed by the Federal Treasury, a gold coin minted in San Francisco, and possibly, in some rural areas, a promissory note issued by a local merchant who everyone just trusted because his father had been trustworthy. These were not all equal. They did not all travel well. A banknote issued by a small bank in rural Georgia might be accepted at face value in Savannah and discounted by 10% in New York. Your money was worth different amounts depending on where you were standing when you tried to spend it. Think about that. Imagine carrying $20 in your pocket today, and when you get on a train and cross into the next state, it is only worth $18, not because of exchange rates. Just because the piece of paper came from a bank that people in this new town were not sure about, that was the reality. And that reality shaped everything about how ordinary Americans thought, saved, borrowed, and lost their money. The system had a name. People called it the National Banking System, and it had been set up during the Civil War back in 1863 by a government that needed to finance a catastrophically expensive conflict. The idea was simple enough. The federal government would charter banks. Those banks would buy government bonds, and in exchange, they would be allowed to issue their own paper currency. It was a deal that helped Washington fund the war, but it left behind an infrastructure that was deeply structurally flawed, and by 1912, those flaws had been tearing the country apart for decades. Here is the core problem. The amount of currency in circulation could not grow and shrink with the needs of the economy. It was tied to government bonds. When the economy needed more cash, like during harvest season when farmers needed to pay workers and buy equipment all at once, the cash simply was not always there. Banks in agricultural regions would get cleaned out every autumn. They would call in loans, refuse new ones, and sometimes, when the pressure got bad enough, they would simply lock their doors. And when a bank locked its doors in 1912, the people whose money was inside did not get it back quickly. They might not get it back at all. The word for what happened next was a panic, and America had them regularly. 1873, 1893, 1907. Every generation, roughly, the whole fragile contraption would lurch toward collapse. Banks would start to fail. Depositors would hear the rumors and run to pull their money out. Other banks, seeing the runs, would stop lending to each other. Credit would freeze. Businesses that needed short-term loans to make payroll would suddenly have nothing. Workers would be let go. Those workers would stop spending. Merchants would stop ordering. Farmers would find no buyers. And just like that, a financial panic would grind down into a full economic depression that might last years. The panic of 1907 was the last straw. It was set off, in part, by a failed attempt to corner the copper market. A couple of speculators in New York tried to buy up enough copper stock to control the price. It blew up in their faces. The bank that had lent them the money to do it started to look shaky. Word spread. Depositors line up outside. Other banks stopped trusting each other overnight. And within weeks, a scheme dreamed up in a Manhattan office building was causing factories in Pittsburgh to shut down and wheat farmers in Kansas to lose everything they had. What saved the country that year was not the government. The government was essentially helpless. What saved it was one man sitting in his library in New York, a man with a thick white mustache and an eye condition that made his nose look red and inflamed in photographs, a man who was so powerful that his personal financial decisions could move entire markets. His name was John Pierpont Morgan, and the fact that the stability of the American economy rested on the private decisions of one banker in his private library was, to a growing number of people, absolutely terrifying. Morgan called the heads of the major banks to his home. He locked them in his library. He told them what they were going to do. They were going to pool their money, they were going to shore up the weak institutions, and they were going to stop the panic. And because the alternative was catastrophe, they listened. The panic was contained. Morgan was hailed as a hero, but the lesson that serious people took from 1907 was not that private bankers could be trusted to save the day. The lesson was that the entire country should never again be dependent on one old man's willingness to throw his personal fortune into the breach. That realization is what eventually produced the Federal Reserve Act of 1913. But that story, the political war that created the Fed, the secret meeting on Jekyll Island where the plan was first drawn up, the compromises and the lies and the competing visions, that is a story for another time. Today, we are staying in the years before. We are staying in the world that made the Federal Reserve feel necessary. Because if you want to understand what the Fed was supposed to fix, you have to understand what was broken. And to understand what was broken, you have to get off Main Street and walk around the back into the parts of the economy that the limestone bank buildings were not built to serve. In 1912, if you were a farmer in the South or the Midwest, your relationship with banking was likely a relationship with one man. Maybe he was the local banker. Maybe he was a merchant who also served as an informal lender. Either way, the terms were whatever he decided they were. Interest rates on farm loans could run anywhere from 8% on the generous end to rates that would make a modern payday lender blush. Crop lien systems, common throughout the South, worked like this. You borrowed against your future harvest to buy the seed and supplies to grow that harvest. And you bought those supplies from the same man who held your debt at prices he set, and you sold your crop through him at prices he also effectively influenced. It was not slavery, but it was a machine designed to ensure that the man at the bottom never quite got free. The term they used for what you owed at the end of the season, after paying interest and supply markups and storage fees and all the rest of it, was settling up. A lot of Southern farmers settled up every autumn and discovered they were deeper in debt than they had been the spring before. Not because they had been reckless, not because the harvest had failed, just because the math of the system made it nearly impossible to come out ahead, and there was nowhere to complain. The man they owed was the only source of credit within 50 miles. The next election was 2 years away, and the government in Washington was busy with other things. For industrial workers in the cities, the picture was different, but not necessarily brighter. Factory wages in 1912 were paid in cash, sometimes weekly, sometimes every 2 weeks. Most workers did not have bank accounts. The bank with the limestone columns and the Greek facade was not for them. They knew it. The banker knew it. Everyone understood the social geography without having to say it out loud. A steelworker making $15 a week in Pittsburgh was not walking into the First National Bank to open a savings account. He was keeping his cash in a tin box under his bed, or giving it to his wife to sew into the lining of her coat, or handing it to a neighbor who was a little better with numbers and trusted by the community. This was not simply poverty. This was exclusion by design. Banks in 1912 set minimum deposit requirements that were calibrated, whether intentionally or just by habit, to keep out exactly the people who most needed somewhere safe to put their money. And so ordinary working people developed their own systems. In immigrant neighborhoods, you had the padrone, a labor boss who also served as an informal banker and loan broker and fixer, a man who held enormous power over his community because he controlled access to work and to credit simultaneously. In other communities, you had rotating savings clubs, groups of 10 or 20 people who each put in a fixed amount every month and took turns receiving the whole pot. In Yiddish, these were called Gemilut Hasadim funds. In West African traditions, the same structure was called a susu. In Jamaica, it was a partner. These systems traveled with the people who created them, took root in American soil, and quietly served millions of people that the formal banking system had decided were not worth serving. The mutual savings bank was another alternative, and one with a longer history than most people realize. These were institutions owned by their depositors, run not for profit, but for the purpose of encouraging thrift among working people. The first one in America had been founded in Boston in 1816, and by 1912 there were hundreds of them concentrated in the Northeast. They paid interest on deposits. They made mortgage loans. They did not have the flash or the political connections of the commercial banks, but they were solid, and they served people who otherwise had nothing. The postal savings system, launched in 1910, just 2 years before our story, was another attempt to reach the unbanked. You could walk into any post office in America and deposit money, and the government would guarantee it. The rates were modest, only 2%. But 2% guaranteed by Washington was worth more to a Polish factory worker in Chicago than 4% promised by a bank that might be gone by spring. Now let us talk about the credit side of the equation, because saving money was only half the problem. Borrowing money, when you were not wealthy, was the other half. And in 1912, it was an experience that could break a person. Personal loans to working people from commercial banks were essentially non-existent. Banks lent to businesses, to merchants, to people who could put up real collateral, meaning property, meaning land or buildings. If you were a wage worker who needed $200 to pay a doctor after your wife got sick, or to cover rent during a layoff, or to buy the tools you needed to start a small trade, you were not going to get that money from the First National Bank. You were going to get it from one of two places. The first was a relative or neighbor, if you were lucky enough to have one with cash to spare. The second was a loan shark. The term was already in use by 1912, and what it described was a network of small lenders operating at the very edge of legality, or sometimes well past it, who would advance cash to wage workers against their future paychecks. The interest rates on these loans, when calculated on an annual basis, were obscene. Lenders would sometimes charge 20% for a 6-week loan, which works out to an annual rate of over 170%. When a borrower could not pay, the lender would sometimes arrange to have himself appointed the borrower's employer's contact, and wages would be garnished directly. People lost jobs when employers found out. Families lost housing. The whole system was predatory in a way that was clear to anyone who looked at it, and reformers had been shouting about it for years. The Russell Sage Foundation, established in 1907, made the reform of small loan lending one of its central missions. Researchers funded by the foundation documented the loan shark business in city after city, putting names and numbers to something that most middle-class Americans preferred not to see. Their reports were damning. In one northern city, they found a network of lenders charging rates that effectively enslaved borrowers in permanent debt cycles. The borrower would take a loan, pay interest, not be able to retire the principal, take a new loan to cover the shortfall, pay more interest, and around it went. Some families had been paying the same debt in various forms for years. The original amount borrowed might have been $30. The total paid out might already be 3 times that, and the debt was somehow still there, still growing, still hungry. This is the landscape of American finance in 1912. It is not the clean, stable world that the limestone bank facades were advertising. It is a patchwork of formal institutions serving the prosperous, informal systems serving everyone else, predatory lenders operating in the gaps, and underneath it all, a monetary infrastructure so badly designed that it guaranteed periodic collapse. It is a world where your physical location determined the value of your money, where the color of your skin and the origin of your name determined your access to credit, where a single bad harvest or a single illness could tip a family from working poor to desperately poor with no safety net to catch them. And here is the thing that gets under your skin when you really sit with this history. The people who built this system did not build it by accident. The exclusions were not oversights. The loan sharks did not operate in a vacuum. They operated in the space that was created when respectable institutions decided certain people were not worth serving. Every gap in the formal system was an opportunity for someone less scrupulous to fill at a price. And the man who ran the formal system The bankers with their limestone columns and their marble counters, they knew about the gaps. Some of them, through holding companies and informal arrangements, were profiting from the very alternative systems that their refusal to serve ordinary people had made necessary. Power does not always look like a man with a whip. Sometimes it looks like a man in a pressed suit, sitting behind a marble counter, with a sign on the wall listing the minimum deposit required to open an account, set at a number he knows most of his neighbors cannot reach. Now we are approaching the moment of change. The panic of 1907 had frightened enough powerful people to put serious reform on the table. A commission was convened, the National Monetary Commission, headed by Senator Nelson Aldrich of Rhode Island, a man so tightly connected to the banking establishment that his daughter had married into the Rockefeller family. The commission traveled to Europe, studied the central banking systems of England and Germany and France, produced a stack of reports, and then the real work began. The real work happened not in a Senate chamber, but in a private railroad car traveling to a hunting club on a barrier island off the coast of Georgia. The meeting on Jekyll Island in November of 1910 is one of those historical events that sounds like conspiracy theory because the men involved worked so hard to keep it secret. The participants were told to use first names only. They arrived at the train station separately to avoid being seen together. The island's other guests were cleared out. For 9 days, the most powerful bankers in America, along with a Treasury Department official, hammered out the basic framework for what would become the Federal Reserve System. They called their draft the Aldrich Plan. It would eventually be transformed, politically reworked, renamed, and passed into law in December of 1913 as the Federal Reserve Act. But the bones of it, the structure of a centralized banking system with a lender of last resort capable of injecting liquidity in a crisis that came from Jekyll Island, from men who were very deliberately trying to prevent another 1907. The debate about what the Fed really was, a public institution serving the common good, or a private cartel dressed up in government clothing, that debate began immediately and has never fully ended. Populists in Congress fought it. William Jennings Bryan, 3 times the Democratic candidate for president, a man who had built his career on the fury of farmers crushed by tight money and deflation, warned that whatever was created must not serve the interests of Wall Street at the expense of the rest of the country. Compromises were made. The structure that emerged was genuinely hybrid, part private, part public, regional in organization, with 12 district banks rather than one central institution, and a board appointed by the president in Washington. Whether it served the people or the banks, or some evolving mixture of both depending on who was in power at any given moment, that is a question serious economists and historians still argue about. What is not arguable is what it replaced. And what it replaced was this world we have been walking through together. This world of panics and loan sharks and monetary chaos and crop liens and tin boxes under beds and rotating savings clubs and postal savings accounts, offering 2% in exchange for being the only guarantee that would not disappear. By spring, the America of 1912 was a country where most people existed entirely outside the formal financial system, not by choice, but by exclusion, where the tools for building wealth, savings accounts that paid real interest, credit at reasonable rates, access to mortgage lending, were rationed by class and by race and by the accident of geography, where the periodic collapses built into the system's very architecture fell hardest on the people who had the least cushion to absorb them. Farmers lost land, workers lost wages, families broke apart under the pressure of debts that had been constructed to be unrepayable. And after every panic, after every crash, after every season of suffering, the men in the limestone buildings were still there. The columns out front were still standing. The marble counter was still gleaming. And a new generation of depositors would walk through those heavy oak doors, wanting to believe that this time their money would be safe. Wanting to believe that the man in the pressed suit standing behind the counter of the most impressive building in town was working for them. That desire to believe, that specific hunger for safety and solidity, and the feeling that someone powerful was watching over your money, that was not weakness. That was a very human need. And understanding who fed that need and who exploited it, and how the system was eventually reformed, at least partially, is not just history. It is a mirror. Because the distance between the rural southern farmer trapped in a crop lien in 1912 and the 21st century gig worker rolling a payday loan from one week to the next is measured not in years, but in the ongoing question of who the financial system was actually built to serve. And that question, friend, does not have a comfortable answer. It never did.